There are two major institutional investment firms that have been consistently bullish on Tesla. First, Cathie Wood of Ark Invest has been buying Tesla stock over the last several months in the face of other firms selling due to the negative auto market sentiment. Ark has bought 2.3 million Tesla shares year to date, raising its total weight to 9.6% of their fund, making it second and about to become the top spot once again. Second, we have Adam Jonas of Morgan Stanley, who has again dropped another note, this time a very comprehensive analysis of Tesla's Robotaxi business and the move of Tesla into a recurring revenue subscription business model. We've got Hans Nelson joining us. Hans has an incredible YouTube channel called Hans C. Nelson. You should check him out after you watch this video. Thank you so much, Hans.
Thanks for having me, Herbert.
So this is Ark Invest and Morgan Stanley. Both are very bullish on Tesla. Ark, what they did was they wrote this whole research on Robotaxi years ago, 5 years ago. They bought a ton of Tesla. And then the last 3 quarters last year, they just started selling a ton of Tesla. And then in the last several months, they started buying again. So now it's back. I don't think it's anywhere near where they had at some point, but it's, at least
definitely not in terms of share count. But it does look like it's pretty close in terms of percentage. And unfortunately, that's the way that the ARK funds work, is that they have basically caps on how much of a position they can hold based on a percentage. And so when Tesla runs really well, they end up having to sell it because it's at overweight in their portfolio. And then when it comes back down, it'll go back to underweight in their portfolio, and they can just let it ride, hold on to the number of shares that they have, since they did have to sell it as it was rising. So then they hold on to what they had, and then it drops, and eventually it gets to the point where they feel like it's kind of bottomed out, and then they start to accumulate back up to their 10% number roughly. And that, it looks like that's about where we are, that I think Cathie feels like we've basically hit the bottom, and she wants to go ahead and load up on as much Tesla as she can to stay within her allocation limits.
So she's obviously not done well, Ark, but she's called Robotaxi correctly, and now it's looking like that her bet is going to pay off. So let's take a look at that. That's Ark. We knew that they were always into disruptive technology. Then we're going to talk about Morgan Stanley, and there's a dichotomy between their research notes, which is very bullish on future of Tesla, but then they're very, very conservative in terms of their price targets. So let's take a look at what's happening to Cathie's Ark Invest. Now, the current top 10 holdings, again, is Coinbase at 9.88%. Tesla's now at 9.28%. It's going to come back up again. I think this might actually be old because they're now at 9.6%. And then you can see the other companies that they've bought here. And it's about to recover top spot in their fund. And this is where, see, it's 9.6%, $2.3 million, only second to Coinbase. So before the current buying spree, Ark had sold Tesla shares for 3 consecutive quarters. The purchases in recent months have taken the fund's total stake to more than 6 million shares. Most of that buying has been done through their Ark Innovation ETF, and has come at a time when Wall Street has been just completely bearish on Tesla. So that's a pretty cool thing about them, is that they do that. Any other thoughts about Tesla on Cathie Wood?
I would just say for people that Ark Invest research really is fascinating. They're great at outlining opportunities, outlining market trends. I love the way that they dive into, converging disruptive technology platforms. But that said, they are, depending on what your investment style is as a person, they may or may not be a good fit for your portfolio. And you don't have to actually own any of the ARK funds in order to get a lot of benefit from their research. So, obviously not financial advice, but I would just put that out there for people that, ARK Invest is a great resource. And whether you're positive or negative on the funds, that you don't have to associate that with the research itself. But if you are going to be looking at purchasing their funds to hold, you really do need to understand the structure of their ETF and how those the investment allocation mechanism that they have in place, how that's going to affect their ability to hold stocks that you care about over time, and whether that is really aligned with your preferences as an investor or not. For me personally, that's not. So while I love their research, I don't own any of the ARK funds and haven't for, a long time at this point. But that said, their research is wonderful.
Okay, I appreciate that. Thanks, Hans. The difference between Ark Invest and Morgan Stanley is that Ark still very much based on that research that they did. They believe that Robotaxi is going to be material and it's going to make the stock jump to 2,000 by 2027. That is a 10x within 3 years from now. They've been, you know, and then like it's quite interesting that they were calling for this 5 years or longer, and of course their stock fell because people were very they just couldn't believe it that it will even happen ever. And yet here we are, possibly Robotaxi being announced or unveiled on August 8th. We will see how far Tesla really is, but we can see that FSD now is possibly there. So their research might actually come out to be accurate.
And we've seen that in
That's
the past that, she had a very
yeah.
aggressive call. I think it was 4,000 or 5,000 that she was calling for back in
Hmm.
2019. And then we actually hit those numbers. Those are obviously pre-split. But we did hit those numbers. I think we're back below them now. But she's made aggressive calls like this and been right in their ability to forecast that type of value being created by the company. And I would have to agree with her that it's very possible that we'll get
Yeah.
Robotaxi or large amounts of FSD revenue between now and 2027, and that when we do, it will completely re-rate the company. And so I wouldn't say we are or we are not going to hit $2,000 a share by 2027. But it's definitely within the realm of possibility. And, she's been laughed out of the room in the past when she made those type of statements and then got to go back and say, oh,
Yeah.
who's the dummy
Yeah.
now?
Yeah, she and Ron Barron both, and yet they've been both correct. Now the difference is that Morgan Stanley believes in the future of robotaxi, but they think that it's going to be past 2030. Let's take a look at the new note they did just dropped. So they did a very lengthy note and research on Tesla robotaxi, the first step in shifting the core business. They've been talking about this for a while now that Tesla's going to make the same move that Apple did. They're going to move away from just hardware and into recurring subscription services or revenue there. And this is the first step, but they still think it's going to be a while. So while they're waiting for August 8th, which is when Tesla will unveil their robotaxi, they said, we believe that Tesla has many attributes that can make it a formidable player, if not the outright winner in the race to autonomy. We believe the more material commercial scaling, though, would be well beyond 2030. So that was their first kind of like comment. So as they set the stage of what's happening right now, first of all, they talked about how that EVs is very low profitability, right? Which is pretty straightforward. There's a recognition that making and selling EVs in a traditional consumer model may not create lasting economic value. Auto industry is one of the most difficult industries in the world. EVs is the least profitable and increasingly most competitive. Low-priced entry-level EVs are likely to be the fiercest sub-segment.
So I want to
Mm,
pause there for just a second.
yeah.
I am excited to talk to Michael Dunn when he gets back from China next week. And I think that, a lot of people are rushing to this conclusion that there's so much competition for these low priced EVs right now in China. And it's true, there's a lot of competition that's going on there right now, but we don't know how much of that is subsidized by the Chinese government. And we don't know how sustainable that low price competition is. I think we are going through an artificially stimulated bubble in those low price segments in China right now. And I do think that that's going to produce some very formidable competitors coming out of China that will become players on a global stage. So I would agree there, but I don't know that um, the doom and gloom that people are forecasting for the EV industry as a whole, like that's going to consolidate down to a few players. it's basically, the price war that happens before consolidation. And that once we get the clear winners and we have the consolidation, obviously Tesla is more than in a strong enough position to be one of those players that, then it'll be Tesla plus two or three or four other players, internationally over the whole globe. And they'll be able to reach a good, stable, competitive footing amongst one another. And those will be decent businesses for anyone who really can do a good job of controlling their costs. And so, I think that people are kind of jumping the gun right now, especially given the fact that this is one of those cycles in the automotive industry where you do have higher interest rates and things are really going to look bad, I think, for the next year or 2 years, in a way that is just a seasonal, cyclical part of the auto industry. And then that just gets even multiplied by the fact that the Chinese government is really wanting to be a global leader in the EV space, and they are kind of investing aggressively to make that happen. And so that kind of throws gas on the fire of
Mhm.
all of this market dynamic right now for that low price segment specifically.
Yep. I'm actually not one that believes that Tesla should not go into that game because there's too competition, too low margins. Tesla's figure this out. They're going to have a really good margin because they're doing unbox model. They've got a better product because they're going to include all these new features that they've done. Anyway, so that's just another story. But let's just, so obviously Morgan Stanley's just saying, hey, EVs are really low cost, low margins. You're going
And
to
they
have a
look
lot
like
of
that
competition.
to all the OEMs. Like for anyone who's not Tesla, for Ford, for GM, for Stellantis, for BMW, Volkswagen, Volvo, Audi, all these players, that is
Mhm.
exactly what that market looks like. And that's why,
That's why they're
it's
not there. Yeah.
conversations with those type of people that gives everyone this
Mhm.
perception about the market.
But in order to win in this game, you have to change the game. And what Tesla is going to do is add additional margin through services like FSD and entertainment and others. And that's what they're setting up here. So let's. The other thing is that many car companies, autonomous vehicle companies too, and the Robotaxi at first they've canceled. And so there's hundreds, if not thousands, of world-class robotics AI engineering talent looking for their next project. Tesla is going to be a potentially attractive destination. Then they say that the path to commercialization of true robotaxis at scale will be both long dated and volatile. So that's their opinion. They think that, okay, they're great. They're still not believers that it's going to happen anytime soon. Sure, they're going to unveil an actual physical robotaxi prototype this summer, but we would urge caution on potential commercialization timelines. While we're bullish in the long term, we believe the adoption curve will be extremely logarithmic, so slow at the beginning and then will rise. And again, they still think it's legal, moral, regulatory, that's unmodelable. You can't model that. And then emblematic of bigger shift, Tesla's business model to real world hard tech, AI, and robotics. While Tesla is still currently largely covered by auto analysts, that over time, investors will witness a shift in the company's business model at the margin to more asset light, software based recurring revenue model. And then, while Tesla's 5 million cars represent the populations of probes collecting visual data from the edge of neural net training, we see a range of adjacent applications. Okay, this is just tremendous amount of potential here beyond just what we're seeing now for cars. And in some markets, such as humanoid robots, address the 30 trillion. So they're very, very bullish. They talk big about what can happen in the future, but then they're very pessimistic about timelines. We'll dive a little bit more on that. But what's your comments on what you just saw there?
Yeah, I would largely agree, with the point there. I do think that if we are going directly to robo taxis and we're not going through some sort of intermediate phase where we're selling FSD as a software as a subscription service to lots and lots of consumers, that might end up taking a little bit longer than people would hope initially. But I think it's also, that would be okay if it were the case. And I understand, just urging a little bit of caution. Like investors should be prepared for that to take longer than they expect, so that they are not overextended or making, types of plays that really multiply their risk. I would agree on both of those standpoints, but it also makes me think about our conversation that we just finished recording about the first of its kind data centers that Tesla is moving into, and those first of its kind data centers really, you think about the types of software services that those data centers have the ability to provide, and especially if those are consumer facing applications, whether that's in the car, whether that's in humanoid robots, or whether it's some other form factor of service. um, it is an area that Tesla seems to be moving more and more in the direction of building real world AI into the every product that they're making. And I think that that is an area where we just, we don't really fathom yet how many things that can touch. Um, and it seems like Tesla's continuing to just be very forward thinking in their ability to build the infrastructure years ahead of time that people think looks crazy in the moment, but then in retrospect, you realize, wow, that was actually a genius move. And now they're in a position to do things that no one else is able to do. Um, and so the implication of an extremely logarithmic curve that Adam is talking about is that even if it takes longer to build into that vertical that you're looking for, that when it does go vertical, man, that is insane.
Yep. Thank you for that. So let's look at more of what they're saying here. Right. So they're saying August 8th, right? This is when they unveil the Robotaxi. It could reignite the conversation around whether Tesla is going to be an AI company or not. And their overweight ratings underpin on the assumption that Tesla could ultimately capture value in the area of, I guess, compute, solving some of the world's most challenging problems, autonomy being one of them, offering a gateway into vast untapped commercial potential. So at least you got Morgan Stanley recognizing that Tesla has tremendous advantages and lead in the space, and they should be considered as an AI company. Tesla's in-house computing efforts aside, Dojo, Tesla may be one of NVIDIA's very largest customers. How have investors stopped to think about why that might be? And then, so as we start talking about Tesla mobility, that's what they call the Robotaxi, Tesla's mobility model. It's that is a pay-as-you-go or subscription-based ride-share network, just like the Uber, at first using human operators, migrating to fully autonomous robotaxis, successive generations, and then through partnerships with other ride-sharing firms, so maybe partnership with Uber they're thinking, or other OEMs through technology network licensing agreements. That's one assumption. Another one is they forecast the inauguration of the service by 2026. So they are not thinking it's going to happen next year. They're thinking it's going to happen 2 years from now, year and a half from now, maybe. 1,000 units in operation. 2030, 157,000 units. That's where I think that their negativity is so crazy here that we're talking, 6 years from now, they're only at 157,000 units. What? Okay.
Yeah,
Rising to
when they can make
1.7.
more than that in a quarter.
I don't understand why that would be. And then all the cars that exist today. And once again, at this time, we expect the vast majority of mobility fleet to be human operated. Okay, what? I guess they're really so negative on regulation.
I think
Uh,
this is just an easy, like, this is the sugar coating that you have to put on the pill to get a
mhm,
lot of institutional investors to even consider the possibility. That's my take personally,
sure,
because this is ridiculous. Like, there's no way,
it's
if it
dumb.
if it works, this
It's
is
good.
not the path that it's gonna take. Either it does
Exactly.
work or it doesn't, and either way,
Yes.
that's not gonna happen.
Well said. That's exactly correct. This is it's so dumb. It's never going to happen this way. If it works, it's not going to be 150,000 units. It could be zero.
Yeah,
But if it's not zero, it's going to be millions.
yeah.
So we forecast mobility to be less than a billion revenues by 2027, reaching 17 billion by 2030. Revenue is driven by a forecast of achieving 9.5 billion miles per month by 2030, 0.07% of total miles traveled. Okay, whatever. So we value now that they value Tesla Mobility at $61 a share this year. This is rough parity with our valuation of the core auto business at around 20% of our $310 price. 20% of our $310. So that is, yeah. So it's $60 is Tesla Mobility, $60 is auto, and that's what
It's
they're
kind of
valuing it to be.
funny that that $61 a share that they have right now is probably roughly what I would put on the value of FSD right now as well. I could put as much as $100 per share based on the fact that we just got our free trial in the model that I have. But one of the things that I've been just observing is it doesn't seem that they are at a point from a safety standpoint that they are pursuing the pricing strategy that I thought they would. I think they turned on the free trial earlier on in the development of FSD than I expected. So I think I would have to discount my $100 a share that I was going to assign when they instituted the free trial. I think I have to discount that down a little bit because I don't think we're quite as far along in the progression as I thought we would be. And so, completely different modeling assumptions. Completely, like I totally don't buy into Adam's theory on how that's gonna roll out. But that said, I do agree that there is a base case of software as a service revenue that is inferred by where we're at today, and it is worth, yeah, somewhere between 50 and $100 a share in today's prices, discounted back from what some very conservative assumptions are about its ability to generate revenue in 2030.
Yeah, I'm more like you said earlier, like the stock price right now, how much you attribute to Robotaxi today. Like you said earlier, I don't care. What matters is if it works or doesn't work, and how well does the technology save lives, and how much better is it than, this is the option play. This thing will skyrocket up because they can now forecast and you can now, figure out the actual potential market versus what is it worth today, and based on the incremental improvements of FSD being rolled out, yeah, hard to say all that stuff. So let's finish off what he said in his note. Number one, he keeps talking about this, which is, the future. In the future, Tesla will become a services and recurring revenue kind of business, just like Apple did. They moved from a hardware only to a services business, and they made that move. And stock rises when you can do a recurring revenue. And, right now they make the bulk of their money through one-time auto sales, but eventually they're going to have SaaS, they're going to have the Robotaxi, they'll have entertainment, they'll have, maybe even as you're selling your inference compute as a service that's sitting in your car. So they are just, that's what they're talking about here, right? Right now, it's the most vertically integrated auto manufacturer dominated by one-time point of sale auto business. But over time, incrementally, they'll start moving the needle towards more capital light models like the subscription model. Tesla revenues we expect autos to be the majority of Tesla's revenue for the next decade. We believe software content licensing will become increasingly important as we expand beyond that. So a five-fold increase in potentially monthly active users represented by its car park from 5 million today to over 50 million by 2034 is an important driver here. And at the current share price of $173, Tesla trades at 63 times forward PE, fiscal year 24 PE, I mean. As is typical for Tesla, the level of investor sentiment tends to follow the share price. The drop in Tesla shares has influenced investor sentiment, reinforcing the share price move in the wake of weaker first quarter delivery. And the expectations, some people are now saying this, and it sounds like they're thinking that this will mean a pushed out Model 2. An increasing number of investors are preparing for potentially difficult few quarters ahead. But they still remain overweight. So that's how they view it. We believe Tesla has significant attributes to be valued as an AI beneficiary. We do not believe Tesla will get credit as an AI company as long as core auto earnings are being revised down. This process may take a few more quarters to see through. over which time our $100 bear case may be in play. So they think it could possibly fall all the way down to $100. Hard for me to see that anymore. And then amidst the seemingly overwhelming bearish other investor sentiments, we reiterate our Tesla price target is still 310. So there's still, again, a bull thinking that it's going to go up in the next year. And this is why auto, energy, AI, robotics company, they just need to see the core auto business stabilize, and then they'll start seeing more of this, being seen as an AI company.
Yep. I would 100% agree with Adam's analysis there. One of the things that I've said for a long time is that cars are to Tesla what books were to Amazon. And, a very, very difficult business segment to get into and to build the right technological infrastructure around. But once you do, it gives you a platform really to launch into a lot more things. And obviously today, the biggest source of Amazon's revenue is web services. And, that doesn't have anything to do with books necessarily, but solving the book problem really gave them the foundation on which they could build the ability to have a shot at creating Amazon web services. And I think that cars for Tesla really provide them with the platform to launch into this real world artificial intelligence landscape. And I think real world artificial intelligence is kind of one of the next frontiers that it provides in the 2020s and 2030s, the types of opportunities that Web 2.0 provided back between 2005 and 2020. And that's where we are. Tesla's positioned very well. And it will look a lot more like software as a service. It will look more like recurring revenue and asset light. Like all of those assessments are true. And Adam's not really trying to narrowly predict it's going to be this form or that form. And that's also intelligent because it really is going to be somewhat hard to say. Obviously FSD and robotaxis are one big opportunity, and humanoid robots are another one, but there are potentially more. He didn't call out the fact that Elon has talked about licensing FSD to other players. That could even be a source of recurring revenue. That could also be a reason that you would need lots of, maybe you need company specific data centers, that the Ford license of FSD needs a stand up of Tesla data centers that are the Ford specific data centers that are really handling all the back end infrastructure of providing that software as a service to Ford as well. And so, there are lots of opportunities that are on the table. Tesla, as a very well run business with Elon at the helm, one of the world's premier executors, will be able to have their pick of opportunities, and they will have the team to be able to capture tremendous amounts of value from the very best of the best opportunities with the very best of the best tools at the very forefront of technological progress.
All right. So, 6 years from 2024 to 2030, it's actually an incredibly long time for AI, for AI world. You know what I mean? Like Elon was just saying, it 10x's every 6 to 9 months in terms of the compute power and the compute capabilities that companies are accumulating at this point. That's just the hardware. The software is also, he mentioned just in his space yesterday, all of this is skyrocketing. So for people to think that 6 years from now, they're just the Robotaxi, again, it's just this weird way to not figure out that the world and landscape is changing every single month in front of you. I'm still a believer that even if Robotaxi, because of regulations or something like that, is delayed, everything that you see here, FSD, neural nets, is applied to bots. And bots is going to be a recurring revenue. That's a hardware that's not going to be sold. It's going to be leased. That's a service that's going to be, generating anywhere from 30,000 to 100,000 per year, forever, per year. So this transition to an AI company, to a robotics company, to a subscription company It's going to happen much sooner. It's going to happen all at once. And so anyways, that's my bull part of me, but I'm also, I guess, when people say you're being too bullish, I say, well, why don't you show me the exponential curve of AI, the exponential curve of Tesla's compute power, the exponential curve of Tesla's FSD capabilities, and tell me that, they're not going to be where they could be in 3-5 years from now. It certainly won't be more than 5 years if that's what you're thinking. Thank you so much, Hans. Appreciate this conversation. Follow Hans on his YouTube channel, Hans C. Nelson. Thanks, everybody. I've created a website that is the most comprehensive resource for the Tesla investor. Please check it out. Simply go to my website at herbertong.com.